We've looked at all these methods to analyze our capital budgeting. We've got the payback period, net present value, internal rate of return. And what we're going to do here is talk a little bit about some of the difficulties and some of the situations in which we have difficulties using these different tools, and then ultimately what method it is that we should be using to make the decisions that we need to make about capital budgeting. But we start by looking at conventional projects. And a conventional project is one that has a net cash outflow and then has a bunch of years of cash inflows. That's what we consider to be our conventional project. And that's what we set up as our examples, really. Most of what we talked about. You make an initial investment, and then the project has its returns. And we talked maybe there's a second investment somewhere along the line. But fundamentally, we've got an investment and then a bunch of cash inflows following it. Now, when we have this conventional project, and as long as it's an independent project, not connected to any other, then the discounted cash flow methods, both net present value and internal rate of return, will lead to the same accept or reject decision. So if the net present value is positive, the internal rate of return is going to be acceptable. If the net present value is negative, the internal rate of return is going to be not acceptable. And so when we have conventional projects, we're getting the same guidance from both of the tools that we have, both of these discounted cash flow method tools that we have. But when we have an unconventional project, and we'll list them in just a minute, we get in a situation where it's possible that the net present value is positive, but the internal rate of return isn't acceptable, or vice versa. And so what we need to do is look at what these unconventional projects are and then talk about what it is we're going to do in those situations. So some of the examples of unconventional projects, and we've mentioned these in the past as well. Project may have an initial cash inflow followed by cash outflows. Okay, we make an investment really in terms, or we're receiving the investment, and then we have to make the cash outflows after we get that initial cash inflow. There may be some years where we have cash inflows and some years in the future where there are net cash outflows. The projects may be interdependent or contingent, meaning if it's interdependent, if we do A, we also have to do B. Or contingent is if we can't do B unless we've done A, something like that, where it's not independent from each other. Okay, they're kind of connected to each other. We may have projects that are mutually exclusive. For example, we have one piece of land, and we could build an office building, we could build an apartment building, or we could build a store. But it's one piece of land, we can either build an office building or an apartment or a store. We can't build all three of them. And we may have projects that have different scales of investments, just different amounts of investments, different timing of the cash flows. We had the example where there's a lot of cash flows at the beginning or more towards the end of the project, different lengths of useful lives. And so when we have these unconventional projects, the ones that are different in some way, it's possible, as I said, that net present value is positive, but the internal rate of return is either not acceptable or it's not as good as other projects. And so this leads to the question, what's the better method to be looking at? Is it net present value or internal rate of return? Now again, they're all tools, we're going to be using all of them, but kind of where are we taking our lead from? Well, the good news for us is it's fairly straightforward. In almost every situation, we use net present value to rank the projects and make our decisions. Because remember, we're trying to increase shareholders' wealth. If we go all the way back to the beginning, that's what these capital budgeting projects are, is trying to maximize shareholder wealth. So we're trying to maximize the dollar amount, that net present value. Because remember, net present value gives us a dollar amount, internal rate of return gives us a rate. And we're trying to maximize the dollar amount. So in almost every situation, we're using net present value. The one situation in which we use internal rate of return is if our goal is to maximize the return on investment rather than trying to maximize shareholder wealth. So if we have a specific directive that what we need to be doing is maximizing the return on investment for the company, then we use internal rate of return. But every other situation, net present value is what we're going to do to rank and make decisions because we're trying to maximize the shareholder's wealth, the owner's wealth. And that comes from maximizing the dollar return rather than trying to maximize the rate of return. So conventional, unconventional, Net present value is the method that we're going to be using to make these decisions. Internal rate of return is part of it. It may help us decide which of similar net present values is a better one for us, because if we're going to get the same net present value, we'd prefer to have a higher rate of return. But in all those conventional decisions, all of those unconventional decisions, we're starting really with net present value, and internal rate of return is what we're going to use to make decisions only if the goal is to maximize return on investment instead of shareholder wealth. So net present value, net present value, net present value, unless the objective is to maximize a return, the rate of return. In that case, we use the internal rate of return for our decision making.